Hey there, this is Adam Winnig and welcome and congratulations on becoming an edge trader. In this video, we got some really important stuff to talk to you about. If you want to become successful as an edge trader, there's a few things that you have to understand, and we're going to cover that exactly in this video. Mainly what we're going to be talking about is having the proper expectations and understanding the underlying philosophies and strategies behind our company and our trading philosophy. So with that being said, I'm going to cut over to a video in just a second. It was a live webinar that we did where we talked about the underlying philosophies and the underlying strategies that separate edge traders than 95% of the retail market out there, and how we're using strategies and philosophies that are used by the institutions like the big banks that are always winning in this game. So in this video, you're going to learn a lot. You're also going to learn some of the strategies of what we actually think about and how our systems are actually put together. Now, this video, I'll warn you, it is a little bit advanced. So if you don't have much Forex trading experience, then you may want to log into your client area and go through the Edge Trading Academy first. And this will give you the foundations. It'll make everything really simple, and then this shall build upon it as well. Now, some of the stuff that we're talking about in this video, you can also find inside of the Edge Trading Secrets book. If you've not gotten that and read that yet, we highly recommend that you read that book as well. Okay, so here we go. You're going to learn the philosophies. You're going to learn the right expectations. We're going to show you backtest results. We're going to show you forward test results and how to actually get the most out of your experience here as an edge trader. Here's what's going to be happening tonight. What you're going to be learning is you're going to be learning why the herd always loses money and what to do about it. You're going to learn why and how the smart money trades against the herd. I realize I just misspelled that incorrectly. You're going to learn about the secret to limited risk and unlimited reward trading, and you're going to learn about the components of a holy grail trading system, okay? Also, we're going to talk about an upgraded G7 that integrates these holy grail components at the end. So that's going to be really exciting. So let me tell you how this all came to be. We had recently, me and my two partners, we'd recently landed a couple of really big deals that we were looking for different trading systems to diversify and to trade with multiple systems with this large amount of capital. And so we started talking to different traders, and we actually came across a gentleman that was not only a Forex bank trader, but he was also a Forex dealer, meaning that he worked at an actual brokerage. So he had unique experience from the retail side of things, working with the brokerage, as well as the institutional side of things, trading with the banks. And when he was trading with the banks, he was responsible for managing millions and millions of dollars. So as you can imagine, he understands some things that most people don't. So we started talking to him, and he was extremely sharp. We were impressed with his trading systems. That's the reason why we started talking to him. And he gave us this book that you guys probably have heard about, Edge Trading Secrets. It was titled something different that we kind of rebranded it here. But he gave us this book that completely blew our minds and had us thinking about Forex trading in a totally different manner. And we had this huge aha moment on why the vast majority of retail traders are losing and why the smart money is constantly and consistently winning. And so once we read that book and we were reviewing his systems that had been proven, we're like, we need to do business with this guy no matter what. And he was really sharp. So we're like, we got to figure out a way to do business. Now, when we started talking with him, he said that he wasn't really interested in partnering with us simply because he wanted to use his trading systems only for private money management and using it for his private high net worth clients. And we were like, no, we need to get this to our community. We need to give this to all of the edge traders. And so finally, after going a little bit back and forth, we were able to come up with a deal with him where he was able to basically say, hey, we're going to, he said, you guys can trade our systems, but there's going to be a cap, meaning that you can only trade with up to $50,000, because he didn't want to be at a competitive disadvantage. And we said, whatever it takes, we don't care. Like, we got to be trading with your systems, and your philosophy has to be the backbone philosophy of our company. And so that's what tonight is all about. It's stemming from this conversation, this partnership with somebody with real experience, not these guys that you see flashing the fancy checks and, these days where they make thousands of dollars on Instagram. We're not talking about that. We're talking about somebody low key that you'd probably never heard of that's dealt with big time money. Okay. So here's how tonight's going to break down. Number one is we're going to be reviewing some of the key concepts from the Edge Trading Secrets book, because you need to understand this in order to understand how these trading systems work. Number 2 is we're going to talk about the 10 keys to a holy grail trading system. And then number 3, we're going to introduce the upgraded Titan G7. Okay. If you guys are with me, if you're excited about this, give me a 777 in the chat box. If this all makes sense to you guys, if you're pumped, give me a 777 in the chat box. Right on, everybody. Just making sure you're still alive and you're still awake there. Okay, everybody's alive. Okay, so let's continue on here. So some of you guys have read this book by now, Edge Trading Secrets, The Unspoken Laws of a Forex Bank Trader, How to Leave the Herd and Join the Smart Money. And if you haven't, again, we highly recommend that you read this because it'll make a lot more sense what we're talking about tonight. Now we're gonna go in and we're gonna rip out some of the most important key concepts of that book that we'll build upon later in tonight's presentation. The first thing that's interesting is most people, when they talk about Forex trading, they talk about technical analysis, which is looking at different indicators or chart patterns to determine how to actually analyze the market and make a trade. And if they don't talk about technical analysis, they talk about fundamental analysis, which is basically reading the news and kind of looking at a broader picture of what's happening in the global economic spectrum. But what nobody talks about is nobody talks about sentiment analysis, which is basically the overall feel of the marketplace, or it's the sentiment analysis is the behaviors and the positioning of different market participants. So for example, sentiment analysis would be, for example, retail traders are long, or retail traders are buying euro US dollar, or it could be institutional traders are selling euro US dollar, right? This is the overall sentiment or the overall feeling of what different market participants are actually doing. Now, in the market, there's 2 different types of participants mainly. There's what's referred to as the herd, which is also referred to by bankers as the uninformed, which is pretty much every retail trader that's out there. And there's also this other side of the retail trading world, which is the smart money. This is the informed. This is the banks. This is the institutional money. Okay, this is the hedge funds. And it's really, really interesting if we take a look at this graph. Now, if you see this blue histogram here below, you'll see that this is actually the overall sentiment of the retail traders in the market, or the herd. And as you can see, retail traders are buying. Okay, they're buying, they're buying, they're buying, they're buying. Now, what's interesting when you look at this, and how is this calculated? You can go into myfxbook. You can see, a sample size of like, I don't know, tens of thousands or hundreds of thousands of traders, and you can see what the overall market sentiment is. Okay, now it's interesting because retail traders are buying, 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 as you can see here by this little upwards tick, right? But isn't it interesting what's happening actually in the market? The market's going down, 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 down. Now, what happens as soon as retail traders start selling, 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 what happens? The market starts going up, 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 up. So the herd and the smart money are constantly trading against each other. And this happens almost always. Like it's insane how often this happens. It's pretty much always. Now look again in this histogram, the retail traders, or the herd, is buying, 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 buying. And what's happening in the market? The market is actually, it's in a downtrend at this point, right? Interesting. Again here, what's happening? The herd is buying, 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 buying. And what's happening here? The market is actually dipping. How many of you guys find this quite interesting? That the herd and the smart money are almost exactly opposite, and the herd over 95% of the time lose their money. Smart money clearly has a great track record. Isn't it interesting how the herd is actually doing almost exactly what's wrong? Wouldn't it be interesting if you just did exactly what the opposite of what the majority of retail traders were doing? You'd probably have even more success, right? So with that being said, there's also something called market phases, which you may have heard of at this point, okay? There's like what's called a ranging market, which is when the market is just kind of going up and down within a range. It's not making any significant price hikes or price plummets. It's just kind of in this range, which you can see denotated by this red box, or by these red boxes, okay? Here's another example of a ranging market, Now, these sideways or ranging or choppy markets where there's no trend, this is actually where the herd makes their money, okay? And it's interesting because this is actually where the smart money doesn't make money. This is where the smart money like breaks even, or they even lose a tiny bit of money, but they're not dumb and they don't blow their accounts because they have good risk management. Now, these blue phases of the market are actually called, these are called trending phases of the market, right? It's where price is actually moving to a higher point or to a lower point. And this is where the herd loses big money, was when the market actually starts to trend, okay? And this is actually where the banks will make the majority of their money, is in these big trending markets. Now, what's going on with Titan G7? There's a lot that we could talk about, but if you have been analyzing the market, you can see that the market has been in a pretty much like a trending, or excuse me, like a ranging or a choppy market for a little while. And good systems, they're going to struggle a little bit during these phases, and when the market starts trending, that's when these systems should do a lot better, right? So that's that. Now, talking about market phases, right? Momentum is the same thing as like a trending market, and mean reversion would be the same thing as like a ranging market, okay? A market that's just kind of going sideways, okay? The interesting thing about a trending market is that when you trade a trend, you're actually going to have a lower winning percentage versus trading in a choppy market. If you're trading in a choppy market or a sideways market, you're actually more than likely going to have a high winning percentage. The interesting thing about a trending or a momentum style of trading is that you'll actually, if you do it correctly, you can have limited risk, but you can have unlimited upside potential reward as long as the trend actually persists. The downfall with trading in a choppy market is that you can have unlimited risk and you can only have limited reward or profit potential, okay? As far as long-term sustainability goes, in a momentum or trending market, you'll actually lose most of the time, but will make up for the big because of, okay, so what does this mean? This basically means that in a trending style of trading, your winning percentage is going to be lower, but you're going to make up for it by having these big risk to reward style of trades where you're making, exponential reward to your risk, okay, which is the opposite of trading in like a choppy or a sideways market, okay? Now, who uses a trend trading system or a momentum trading system? This is what the smart money does, okay? Who trades a mean reversion or in a choppy market? This is what the herd does, okay? And if you read the Edge Trading Secrets book, it goes a lot more into depth into why this actually happens, but it has a lot to do with the herd psychology and not being able to weather, a month or 2 or 3 months of a flat market where you're not really making money, because most retail traders, they just want to make money every single day, or they want to make money every single week. And that's great and all until you blow your account, which we're going to talk about later on, okay? So in the book, he gives an example of a hypothetical example of what when he was working at the bank, is that this is what the banks, when he was working at the retail brokerage, he said this is what the brokerage would actually look like as far as their profit and loss statement. And this is what retail traders or the herds profit and loss statement would look like. So let's say, for example, on 7/2, okay, so July 2nd, profit and loss, negative $50,000 as the market is sideways, okay? This is where the institutions and the smart money is losing money, but the clients have a positive $60,000, okay? So the clients are making money and the brokerage is losing money. Now, this is an example of what's called a B-book broker, meaning that they trade exact opposite as the clients. Isn't that interesting, okay? Now, on 7/3, and you wonder, why are these B-book brokers so profitable businesses? Well, they just trade against the herd or the uninformed money, right? Now, moving on. Next day, the B-book broker loses $30,000 because the market continues sideways, but the clients realize another $45,000 in profit. So good for the clients, bad for the B-book or the smart money. Move on to 7/9. The market continues to move sideways. The broker's down another $40,000, but the clients realize another $55,000, okay? So overall, in this sideways market, the broker has lost a small amount of money and the retailer, the clients, have made a small amount of money. Now, the market bursts out into a trend on July 10th in a strong up move. The broker makes $400,000 and the client sits in $450,000 in unrealized losses, which is basically drawdown, right? Interesting, as soon as a trend comes. Comes 7/11 or July 11th, the broker profits $650,000 as the market continues to go up, and the clients end up getting stopped out of their positions that they're holding on to, and they lose basically $600,000. Isn't that interesting? Isn't that interesting? By simply trading against what the herd or the sentiment of the herd is doing, B-book brokers are able to have extremely lucrative businesses. How many of you guys find this interesting? If this is interesting, you guys, give me a 777 in the chat box. If you guys are finding that this is like an aha moment for you, or if this is interesting to you, that, wow, like this is, you know, holy crap, like nobody's ever put it out like this for me, or I've never seen it explained this way. It's eye-opening, right? Moving forward. The next thing he talks about in the book is smart money manipulation, okay? Retail traders, we've all been taught that we want to buy low or buy when it's cheap, and we want to sell when it's high or sell when it's expensive. And the challenge with this sort of thinking is that we're not trading with the trend. We're just trying to catch the bottoms or the tops of the marketplace, which can work in a sideways market. But once the market goes on a trend, like it always does, then that's where the herd loses their ass, okay? Excuse my language, okay? Now, another thing, support and resistance, right? How much have we been taught about support and resistance? Well, everybody's looking at support and resistance, and smart money knows that retail traders are taught to look at support and resistance. And how many times, if you've actually traded, have you seen support and resistance break, right? It happens all of the time, okay? And the problem with trading support and resistance is the fact that, well, again, you're not necessarily trading with the trend. And the other problem is you're trying to catch the tops or you're trying to catch the bottoms. And if the market goes in a trending situation, that's where you're going to lose big time, okay? Another way that the smart money manipulates the herd is with common indicators, right? Common indicators like, for example, like an RSI or stochastic that shows when a currency is overbought or oversold. Okay, the smart money knows that all of the retail people are looking at this and, oh, it's oversold, we're going to buy up, right? Well, the smart money understands that, and they're just going to trade against you. And that's why over 95% of the herd actually loses money, okay? Now, win-loss versus risk-reward. This is something that is just fascinating, okay? So let me show you some actual proof here to back up this statement, okay? Now, this is a graph that shows, let's actually look at this one first. So this actually shows the winning percentage. So out of 100 trades, for example, with, let's look at Euro US dollar. Okay, so that's like right here, right? Out of 100 trades, they're going to win like 61%. So the herd is actually right 61% of the time. How do they lose money? Okay, if you're right 61% of the time, you should be profitable, right? Well, the challenge is that the risk to reward ratio of the herd is horrible. Okay, it's below a 1-to-1 risk to reward ratio. And even though the herd picked 61% in this time frame, winning trades, they won 61% of their trades, they're still at a net loss because the risk to reward ratio is less than 1-to-1. Now, how important is actually having a 1-to-1 at least risk to reward ratio? It's extremely important. This is interesting. This is a graph from, I guess, 2014 to 2015. It's a little bit outdated data, but it's the exact same pretty much as it is now, okay? Now, this is what it basically says, okay? The red box is basically, they did not have a risk to reward ratio, at least a 1-to-1 risk to reward ratio. The blue means that they had a 1-to-1 risk to reward ratio or more than a 1-to-1 risk to reward ratio. And look at the difference, the potential of profitable traders, of people that had at least a 1-to-1 risk to reward ratio compared to this. It's almost like 3 times or greater. You literally have a 3 times or greater chance of being profitable in the market if you have at least a 1-to-1 risk to reward ratio, okay? Interesting, right? Very, very interesting. Okay, now this is something that you guys got to get, okay? This is something that blew my mind when I saw this. Now, most people think about trading as a normal, and we're going to get into statistics here a little bit, so don't freak out. You may remember this from your high school statistics class, right? A bell-shaped curve, right? If you look at heights or average weights, it kind of falls. Everyone falls in this bell-shaped curve with the majority ending kind of right in the center and fewer on these tail ends of outliers, right? Like for example, let's say that the average baby is like 7 pounds. Okay, they're gonna line up right in the middle, where at the fat end of the tail is maybe like a 13-pound baby, right? Like it's way out there. It's very, very unlikely. Or say you have like a 3-pound baby, right? It's really, really unlikely, but it's on this other side of the tail. Now, what's interesting about trading in the Forex markets and in any market actually, as a matter of fact, is that it's not exactly a bell-shaped curve. It's actually a different style of curve. I think they call it like a Gaussian curve or something like that. I don't remember exactly. It's in the book. But basically, they have these fatter tails where there's actually a higher probability that these big moves can actually happen in the market. Okay, so tail risk. This is the fat tail risk, right? Let me just read this for you. Tail risk and tail reward is the source of heavy losses and heavy gains in the financial markets. Retailers are incapable of assessing this tail risk. Thus, their trade styles and psychology will make them lose. They assume that the market will follow normal distribution, the blue line, whereas the reality is the market is a levy flight, the red line, meaning that there's these huge moves in the market that on the bad side of things can totally wipe you out. On the good side of things can make you an absolute fortune, okay? So the tail reward, which would be this side of the thing, of the graph, is the probability of an extreme move that will result in a huge profit in your position, okay? The smart money embraces this tail reward and limits the tail risk by cutting their losses short, okay? Now, on the other side of the thing, the tail risk is the probability of an extreme move that will result in a huge loss of your position. Retail traders embrace this tail risk and cut off the tail reward by holding on to losses and cutting profit short, right? So, by the way, is this making sense to you guys? If this is making sense, if you're following me, would you please give me a 111 in the chat box? If you guys are following this, we're going to need to explain this a little bit more in depth, okay? So it's not a bell-shaped curve. There's huge opportunity for losing and huge opportunity for winning in the market that most people don't really even, are not even aware of. It's not a bell-shaped curve. It actually has these fat tails. So do you guys see how if we could capitalize on these fat reward tails and minimize these fat risk tails, that we could actually have a lot better trading system? Does that make sense to you guys, by the way? If that makes sense, just write yes in the chat box. If you guys are following along, yeah, okay, everybody writing yes. Okay, so good. I just want to make sure that makes sense to you guys. And when I first heard this was a huge eye-opener to me, right? Now, that's kind of the basic foundations of this. Now, let's get into this and talk a little bit more practically about these key concepts that we just went overview, okay? The 10 keys to a holy grail trading system, okay? Is there such thing as a holy grail trading system? And the answer is not really, but also kind of, okay? So we're going to talk about what are the keys that would actually make up a hypothetical holy grail trading system, okay? So let me read this to you because this is important noting. It's a little bit long, but it is so important that you understand this. Listen, good long-term robust systems are very psychologically difficult to trade due to an unstable short-term balance curve in long drawdown periods. Most retail traders want profit every week or every day or every month, but the market will only pay a premium or an alpha to the traders who have the mental strength to trade difficult long-term and robust systems, and will punish traders who try to rob the market little profits every day or every week. The trading edge is not in the system itself, but in the trader's psychology and discipline to trade through months of stagnation with no result, but to still persevere and wait for the big trends. A quality that very few traders or investors actually possess. The reason that the crowd has been and always will lose at the trading game is that the sheer mental strength required to be a successful trader is higher than they could ever achieve. Now, just knowing that, how could you change your psychology, okay? Knowing that good long-term systems are psychologically difficult. I mean, it's difficult to see a system losing or stagnating for a month or 2 months or 3 months. That's difficult. How do you stick with it? Especially if you're paying a licensing fee and you're paying $150 a month. How do you have the psychology, the mental strength to stick to it? It's challenging. But if you want to be the very few who make the fortunes in the market, then you got to get that sort of mentality, okay? So here's the 10 keys to a Holy Grail trading system. Let's go ahead and get into it. Number one is a Holy Grail trading system, if there ever was such a thing, would embrace the tail reward and limit the tail risk, right? So we're going to catch these big moves in our favor, and we're going to limit these big losses in our favor, against our favor, right? So how could you do this? How could we capitalize on this fat tail? Well, one thing is by having fixed stop losses, right? If you don't have a fixed stop loss and you just let your trades go against you, you run the air of catching this fat risk tail, right? How could we also embrace the tail reward? Things like trailing stop losses, right? Where if the market really goes in a trend and you just keep riding this trend, you can really catch the fat tail of this reward, right? Another thing that we can do is use a favorable risk to reward ratio. Well, what's favorable? Well, 1-to-1. Guys, you have like a 3 times higher chance of being successful if you simply have a 1-to-1 risk to reward ratio. Anything even slightly above 1-to-1 risk to reward ratio is going to be really, really helpful. Another thing is how could we embrace the tail reward and limit the tail risk is following the freaking trend, okay? Following the trend. One of the things he talks about in the book is that most indicators are crap. Most indicators are not that helpful, but one indicator that could be helpful is a moving average. You know that at least what the trend, what is actually happening with the market, where the trend actually is, okay? Does that make sense how we could embrace the tail reward and limit the tail risk? Cool. So number 2, this is again 10 keys to a Holy Grail trading system. Number 2 is don't use a limited reward, unlimited risk system. Hello. Okay, examples of this, martingale. Okay, if you guys aren't familiar with martingale, it's simply where there's a million bajillion bots like this out on the marketplace. And sure, if you're unsatisfied with not making profits every month, go try a martingale system. I guarantee you'll blow your account eventually. Why? How do I know that? Because I've done it. Okay, martingale systems are simply where if a trade goes against you, you'll continue to increase your lot size in an attempt to recover the lost trade, right? Where you have, think about this, with any martingale system, you have a limited potential reward, but you have exponential, and you literally have unlimited risk, okay? So if you're trading any sort of martingale system or any sort of system that progressively increases your lot size as a trade goes against you, it's just, you're doomed for failure. We're gonna talk about that later, but it's just like I feel like a calling to try to help as many people as possible because so many people fall for this trap. I fell for this trap. You get sucked into the daily rewards or the weekly rewards. In long term, it's just, I mean, just watch what'll happen. It's not going to be pretty. You're going to blow your entire account. Okay. Grid trading, same sort of similarity. Okay. It's something where you have unlimited risk with only a limited reward. Using wide stop losses, right? If you have really, really wide stop losses, say you're using like 250 or 350 pips, dude, you got so much risk. And what is your take profit? What do you take profits 30 pips or something? You have a horrible risk to reward ratio. And you're really bound for failure because you're on this fat tail end of the spectrum, okay? Averaging, what is averaging? Okay, cost averaging, you've probably heard this. As the market goes against you, you keep say the market is falling, you keep buying and then you buy more and you're hoping to catch the bottom of that market, but it's just a recipe for disaster, okay? Because you, again, have unlimited risk with only a limited reward. Does this make sense to you guys? If you are promising me to never trade a martingale system again in your life, will you please give me a 777 in the chat box? If you're following me, if this makes sense, even if it's more difficult to trade a long-term robust system, okay, good. I really want to make sure you guys understand this because it's just, it's so easy to fall into that trap. And there's so many people, okay? Joshua said he blew his account with that. Like, two Joshuas had, blew their accounts. Okay. So there you go. Okay. Anything that you're increasing your lot size against the trend or against your position, it's just not a good thing. Okay. And you'll learn the hard way or you'll just listen here tonight. Okay. So number 3, cut the losses short and let the profits run. Again, this is the 10 keys to a Holy Grail trading system. Cut the losses short and let the profits run. Okay, how could you do that? Again, we talked about something like a trailing stop loss when the market goes in these big trending fashions, which it always does. That way you can catch this fat tail of the reward spectrum. Okay, this market, we have a limited stop loss, so we'll take a small loss, but we're willing to see it go up and have a lot of upside potential. Okay. Number 4, follow the friggin' trend. I mean, come on, like, look at this. I mean, if you want to just do what the smart money does, the smart money loses a little bit of money or breaks even on in the trending markets. And then when in the ranging markets, so the sideways markets, these red markets, but when it starts trending, that's when they make all the money. I showed you guys the P&L of the broker. That's when they make all their money and the retail loses all their money. Okay, so simply following a trend is a key component to a holy grail trading system. Okay, scale into the trend as the smart money does. What does this mean? It means if you see a trend building, instead of taking your profits, want to add positions in to the trend, which may be psychologically very, very difficult to do because most people, they can't do that. They think, oh, the trend's over. Like, I got my money, I got my profits, I got out of it, which a lot of the times people cut their profits too short, right? And let their losses run too long, okay? So scaling into the trend as the smart money does, okay? Number 6 is having a low win rate but high reward trading system. Okay, guys, I explained this to you earlier, right? Euro US dollar, the retail knows how to pick a winning trade. They did it 61% of the time, but they still lost money because their risk to reward ratio was way off. So one thing to beware of, is beware of systems that have really, really high win rates, but have a poor risk to reward system. If you want more information about that, if you're currently trading a high winning rate system, just read the book. All the math will totally make sense to you. If you don't already kind of get the picture, read the Edge Trading Secrets book, okay? Number 7, preserve capital for the long run, okay? This is a key. Can you preserve your capital for the long run? Meaning that, can you weather a ranging or a sideways market in order to make big money in the trending market, okay? Number 8, watch out for extremely smooth balance curves, okay? Look at this, or equity curves. Look at what's happening. This looks so beautiful. Man, like if I could just put my money in here, I'll put in $10,000. It's going to go up 600%, or it's going to go up, 600%. Man, I'm going to make, what 60 grand. Like, wow, I'm going to grow my money exponentially. And look, it's so beautiful. It's so pretty. And look, it's winning 75% of the trades. And look at the profit factor. It's 2.52 profit factor. Well, look, this is a prime example of a martingale or an averaging system or a grid system or even a hedging system. This is a prime example of what happens. These sharp decreases in equity. Again, it's bound to happen. You're going to have these massive equity fluctuations, and it may look good for a while. I'm so guilty of this. I'm so guilty of this that I did this. I had grown one of my accounts by over 100%, and I'm so thankful that I got this information, got out of the martingale systems, because what happens next is, boom. This is how the martingale systems or the averaging systems end up, okay? And I'll almost guarantee any single one, they'll absolutely do this. If you have a true edge, trading edge in the market, then you don't need to manipulate manipulate your position size in order to make it actually work. This is what happens when you do it. You may get lucky for a while, but eventually this is bound to happen to you. And it's very difficult to know when to get out of these systems before this actually does happen to you, because it can happen at any time. The market's very random, okay? Are you guys following with me? Does this make sense? If this makes sense, give me a 111 in the chat box. Give me a 111 in the chat box if you guys are following. Okay. Okay, if you never buy a single product from us, I don't care. If this just saves you money down the road, if you're looking at other trading systems, then this will be worth the time tonight, okay? So that's number 8. Number 9, what's a key component of a holy grail trading system? A stable rising equity curve above the balance curve. Now, this was interesting. I did not know this until we formed a partnership, until I read the Edge Trading Secrets book. But you actually want to look for a system where a majority of the time, the equity is actually above the balance curve. Now, what does that mean? It means the yellow line is actually above the red line when you look on like myfxbook, for example. I think a lot of us are familiar with myfxbook. You want to look for a system that actually has a rising equity as a result of this. Now, also notice that this curve does not look as pretty as those martingale or gridding or hedging or those averaging systems. It doesn't look as pretty. It's psychologically much harder, but in the long term, you're going to be a lot happier because you're not going to freaking blow your account. Okay. So again, this is a key that you want to look for when you're analyzing any system. Okay. I don't care if you're analyzing competitor system, go ahead and look at their equity curve. What does it look like? Okay. Number 10, of a key component of a Holy Grail trading system is long periods of shallow stagnation followed by burst of profits, right? Again, look, what do we see happening constantly here? We see burst of profit, and then what do we see here? It's stagnating, okay? This kind of could look like G7, right? It's like up, it's down, it's up, it's down, but it's like kind of down a little bit, right? And it's this period where maybe it goes on for a month or 2 months, or heck, it could even go on for 3 months, and then boom, you have burst of profits. And then it gets shallow and it's shallow. Look, it's been shallow for a while, and boom, burst of profits, right? Because the market goes from these ranging or sideways phases where you're just going to break even, or you're going to lose a little bit of money, or maybe you'll make a little bit of money, and then boom, when the trend hits, that's when good long-term robust Holy Grail systems will actually make money. Okay, does that make sense to you guys? Okay. Now, I just want to reiterate this now that we've went through the 10 keys to a Holy Grail trading system. Let me read this again to you guys just to make sure we're on the same page. Good long-term robust systems are very psychologically difficult to trade due to an unstable short-term balance curve and long drawdown periods. Most retail traders want to profit every day or every week or every month, but the market will only pay a premium or an alpha to traders who have the mental strength to trade difficult long-term and robust systems. And it'll punish traders who try to rob the market of little profits every day or every week. It'll punish traders who try to rob the market of little profits every day or every week, okay? Even though it might be nice with the martingale system to see little profits every day, okay? But long-term, no, okay? We already know that. We just went over that. The trading edge is not in the system itself, but in the trader psychology and discipline to trade through months of stagnation with no result, but still persevere and wait for the big trends. A quality that very few traders/investors actually possess. The reason the crowd has been and always will lose at the trading game is the sheer mental strength required to be a successful trader is higher than they could ever achieve. How many of you guys are committed to mastering your mental psychology that you're willing to accept right now on this call that, look, I know that a good trading system may have stagnation periods or may have drawdown periods, but in the long term that I can hold on even through a losing month or through a stagnant month. If you're able to do this and you're going to be one of the 1% that actually makes money in the markets, give me a 777 in the chat box. If that's you, if you're committing to me, to everybody on this call, that you're going to be a long-term successful trader that actually trades with an edge and doesn't use these, money management, gimmicks, then give us 777s in the chat. Okay, look, everybody, you guys are amazing. Okay. You guys are amazing. Okay, thank you for all the participation. That's fantastic, okay? Let's continue on here. Okay, so where could we possibly find a system that incorporates the 10 keys to a Holy Grail trading system? Would it be nice if, the guys over there, Tyler and Joe at Blue Edge Financial, what if they could actually find something that incorporates all this stuff into a trading system? Wouldn't that be pretty cool, right? Well, that's exactly why we decided to partner with our partner that was a trader at the bank that wrote this book. He actually put together a system that we're very, very impressed with, and we fought and to actually allow him to make this available to retail traders like our community, okay? So introducing Titan G27 or Titan G27, okay? This is a completely upgraded, revamped, completely new trading system that I think you're gonna like. So let's go ahead and actually dive into it, okay? Now, what is the system edge behind Titan G27? Well, it's all the stuff that we talked about. It's gonna, majority of the time, follow the trend. It's gonna stay in minimal positions in a sideways or a choppy market. We are gonna add to winning trades in a strong trend, just like the smart money does. It's going to cut off the fat tail risk by closing losing trades quickly, and it's going to embrace the tail reward, okay? It's going to have a minimal number of simple trading rules tested on large historical data, okay? One thing that we learned with the existing Titan G7 was that it was over-optimized, okay? It used a lot of different indicators to get into different trades, and it was over optimized where it worked amazing during a certain period of time. But when you take it out of that time frame, it doesn't perform as well, okay? So having simpler trading rules and a fewer number of trading rules will allow a system to actually become more robust, and that's just something that we learned from our partner that's the trader at the bank that developed the system. Okay, how does this work? What is the portfolio construction like? Okay, it's going to trade a total of 27 different Forex pairs and metals, including gold. Okay, it trades gold pretty heavily. A high degree of diversification allows for a more stable equity curve and high recoverability. Okay, it is going to trade contra crowd based on market environment. One of the cool things is that
our partner was able to create a custom basically indicator that will read the overall market sentiment of what retail traders are doing and basically for the most part do the opposite, right? Which is, it's insanely cool. Okay, this is not a common indicator. You can't buy that anywhere, but it is something that you'll notice that it'll trade against what the herd is actually doing. It stays in small controlled drawdown during low volatility, but can make significant risk adjusted return during high volatility trending markets. Okay, so again, guys, be aware. During a ranging or a choppy market or a sideways market, the system may not make tons of money. You may make a little bit, and it may not lose, tons of money. It may lose a little bit, but during the trends is when we should see a big outbreak in profitability. Okay, execution reliability, cross-testing on different brokers. Data set must show similar profitable results. Strategies are not sensitive to slippage or server disconnections. Okay, this is one thing that we worked really hard on is trying to make systems. The system make sure it was robust enough to trade across different brokers. We noticed with Titan G7 that people's results would vary greatly dependent upon their broker. So we went in to fix that. Okay, here's what the settings will look like. It's very, very simple. It'll look very similar to the existing G7. Almost exactly the same. There'll be a couple different URLs that you're going to have to put in, but as far as, conservative, moderate, and aggressive settings, conservative would be about a 0.01 per 2,000. The max expected drawdown would be around like 20%, okay? Moderate would be about a 0.01 per 1,500. The max expected drawdown would be around 30%. And an aggressive trading system would be a 0.01 per 1,000 with a max expected drawdown of about 40%. Now, how do we do that? Okay, if you guys are using any of our systems, you're probably pretty familiar with this. It's strategy number 2. You turn it on to true. You say, I want to do 0.01 per 2,000. I want to be conservative. I want to do 0.01 per 2,000. I want to be moderate. I'm going to do 0.01 per 1,500, right? Now, the way you can also calculate the max drawdown is that the max will be like 3,000 pips. And if you want to play it extra safe, plan for 4,000 pips. Okay, so do the math. If you have a $1,000 account, you're trading this lot size times 3,000 pips, what would that be? Right? Okay. And yeah, so that's that, right? So for example, how to calculate that, right? We have a $1,000 trading account. We're doing 0.01. Okay. Let's say 3,000 pips. Okay. That's $300. That's $300 to $400, right? 40% of the accounts. That's how we calculate that. Okay. So here's something else that I think you guys will appreciate is it's not that we just have back test results, but we actually have forward test results as well with this system that is pretty impressive. So let's go ahead and take a look at some of these forward tested results, okay? This is a forward test that has been running since basically March 23rd. You can see that it's averaged monthly 8.5% with a max drawdown of 9%. It's overall done, 29%. You can see here the winning percentage. It's not one of these huge winning percentage systems, it has a slight edge on the market, right? And what is the risk to reward? I mean, look at it. 204 pips is the average win. 178 pips is the average loss, right? Okay, so maybe a lot different. It has this working for our favor, which we know we're going to have 3 times around 3 times higher chance of being profitable just by putting this into our favor. Okay. So yeah, this is really good. Now, the interesting thing about this is that this is a fixed lot size. So this has just been trading at 0.01. So this would be considered, ultra conservative, right? This is considered ultra conservative. And I can pull up these FX books if you guys want me to too at the end of it and just show you that. But I just took screenshots, so I can show you guys that if you want to. Now, this is another account that has been running for a little bit longer. This has been running from since February 3rd, I believe, or February 2nd is the first date. Overall, it's done 41%, and it's done 7.53% monthly with a drawdown of 5%. You can see it has one of those equity curves, again, where the yellow line's above the red line a lot of the time. And this is extremely conservative. This would be like a 0.01 per like $3,500. Okay, so it's very, very conservative, this trading system. And, so you can set your risk however you want to. But you see, again, the average win's been 209 pips. The average loss has been 157 pips, right? And you see we have a 58 to 57% win ratio. Okay, so these are the forward tested results, which, by the way, how many of you guys think this is pretty good? How many of you guys are excited about these results? If you're excited about it, give me a 111 in the chat box. Okay, yeah, pretty good, right? And again, this is very conservative. Most people will be trading a lot more aggressively than this. Personally, I'll probably do zero point 0.01 per 1500. I'll do something more moderate, right? Versus this is like a zero point 0.01 per like 3500. It's actually a fixed lot. Okay. So moving on here, backtest results. So let me actually go ahead and show you the backtest results now. Obviously, the forward test results are extremely important, but so are the backtest results to be able to show this over time. Let's see if I can't just pull this up here. So let's take a look here. And I think the boys are going to make this available to you guys. Joe and Tyler will make this available to you guys. But you can see here over since 2007, and you may be asking, why didn't we run it since 2004? Well, since it trades like 27 different pairs, it's really, really challenging to find data for some of these more exotic pairs, some of these minor pairs past 2007. And if you do find the data, then sure, you can go ahead and run it on, till whatever date you have the data from, but it's good luck. You're probably not going to find the data for it. But as you can see, it's pretty impressive. The majority of the months are green months. There's a lot of months that are just small little profits, and there's some months that have big, huge profits, right? You can see the average monthly return for the year over here. You can see the average monthly. This is a 0.01 per 2,000. You see the max drawdown there as well. This would be considered conservative. This would be considered moderate, okay? You can see the average monthly return over here for the year. You can see the losing months in red. Yes, there are losing months, okay? Not a lot, but there are losing months. You can see the average there. You can also see 0.01 per thousand, which would be considered aggressive. You can also see this. You can see the stagnation period was about 133 days. What does that mean? It means that a new equity high for this period of time, okay, there was no new equity high. It was just flat. It, lost a little bit of money, gained a little bit, lost a little bit, gained a little bit, and it was completely flat, right, for 133 days. That's like almost 4 months. Okay, can you see why it can be difficult psychologically to trade a system long-term that's a good system? It's difficult, right? It's not easy. And that's why the vast majority of people don't win in the market, is because they don't have that sort of outlook. Okay. And again, we'll make this available to you guys. You guys can see, anything in depth that you really want to see. We've done a lot of the testing already for you guys, so that way you don't have to do it. Okay. Now, with that being said, there are limitations to backtesting. Hello, like the back test is not going to equal the forward test. It's not, okay? Why not? Well, there's variable spreads in forward testing, right? With the back test, you can set the fixed spread to like 10 or 20 or 30 or 40, whatever you want to set it to. But in the real live market, the spreads are fluctuating. Sometimes it's less than 10, sometimes it's more than 10, okay? Other things like broker commissions are not taken into account in back tests, right? Which do happen in live forward markets, right? Slippage, okay, during like high volatility or where price is moving a lot during the news or something, slippage can occur, okay? Positive slippage and negative slippage where maybe, you wanted to get out of a trade at a certain point, but it couldn't fill your order fast enough, so it, went more against you, okay? That can happen, okay? Swap fees, if you hold a trade over the daily changeover period, those can also come in. So these are back tests, right? This is not, absolute, it's going to move forward exactly. And as a matter of fact, you're probably going to have slightly worse results, right, than a back test result when you move forward because of these unknown variables that you can't count in during a live test. Okay. So, compare the forward test to the back test. You guys can do this on your own, but we found that the forward test and the back test actually, thankfully, they're matching up pretty well. Like they're not exactly, the forward test isn't quite as good as the back test, but it's matching up pretty good. And we're seeing some pretty strong correlation between the two. Okay. Back testing. Now, you guys are not going to be able to back test. Actually, I'll have Joe come on here. I don't know if we're making a file available for backtesting, but basically we've had to do some stuff for the EA security, okay, which we've had people in the past that have tried to like hack our stuff and whatnot. And so long story short is we had to do some stuff to protect the intellectual property and to protect it. So you may not be able to backtest the system. The other thing that we've done is we've made the setup process a lot easier. So it's actually just going to be one EA that you can install on any chart, and it'll start trading all 27 pairs, okay? And the reason we did this was there's less chance of error, right? A lot of people, they're like, why are my results as good as yours, Adam or Tyler or Joe? And a lot of times they just had the thing set up wrong. So we did this in order to help people minimize the human error potential, right? Compatible with every broker, right? We tried to make a system that it didn't really matter to the broker as much. So you wouldn't have that much different results with different brokers, okay?